timing. Yeah, some mishaps took place and we just had to readjust the stuff.
Good evening, everyone. Welcome to episode 7 of Fatra. This is Mehdi here, Fatra's co-founder. And tonight with us is Miss Olivia Vande Woude from Ava Labs. So in this episode, we would like to talk more about the private credit and basically the restructuring role of private credit in the tokenization architecture, if you wish. So without any further ado, I would like to hand over the floor to Ms. Olivios, and we would appreciate if you could have a quick intro on your role at Ava Labs so that our audience will get familiar with that. Please.
Yeah, absolutely. Thank you so much for having me. I'm thrilled to be here. My name's Olivia Vande Woude. I am the tokenization lead at Ava Labs. And Ava Labs is supporting the growth and adoption of the Avalanche blockchain network. For those who are less familiar with Avalanche, Avalanche was built from day one around one core mission of tokenizing the world's assets. And the key differentiator in the network is rejecting the single chain thesis and the idea that everything from stable coins to equities to bonds to meme coins has to flow through one pipe. Alternatively, Avalanche allows anyone, be it an institution, a government, a fintech, a startup, to deploy their own purpose-built blockchain that's customized to their business needs, their compliance requirements, and jurisdiction. And these chains run parallel but can interoperate natively. So digital dollars can move from one chain to buy equities on another, trade commodities on a third, et cetera. And a practical example is that, FIFA launched a layer 1 blockchain. They decided they weren't going to deploy along meme coins and potentially other congestion within the public permissionless C chain that we have in the Avalanche ecosystem. They needed to build their own chain with their own economy of collectibles and ticketing and payments and loyalty, all under their own rules. Same logic applies to another company we're working with called Denari. They focus on tokenized equities with actual custody and broker-dealer infrastructure. And then there are others like Apollo, BlackRock, Franklin Templeton that are already live on our public permissionless chain. So all that's to say the bet is pretty simple that over the coming decades, blockchains will be the rails for value transfer, the way that Web 2 became the rails for information transfer. And there's not going to be one chain. There will be thousands that are purpose-built. And Avalanche is really positioning as the infrastructure that makes that proliferation possible.
Great. Okay, so let me jump to the first question over here. I mean, we've got a series of questions, obviously. So the first one is, we'd like to know, how do you assess the current state of private credit and its growing role in the global capital markets? So this one is more of a general question.
Yes, private credit has been a major area of focus for us at the Ava Labs side. We recently hosted our Credit Reimagined Summit, convening allocators and builders together. But to answer your question, private credit has really become one of the defining asset classes of the post-GFC era. It's a multi-trillion-dollar market that's absorbed lending activity, that was once dominated by banks. And the growth there, in my opinion, reflects three forces. One is bank retrenchment from middle market and specialty lending under the tighter capital rules, especially in the US. Institutional allocators chasing, floating rate yield with lower mark-to-market volatility. And then also the rise of these fintech-driven origination platforms that are generating high-quality, data-rich receivables across consumer, SMB, and B2B payments. And what's really striking is how concentrated the market has become. There's a handful of large managers, perhaps, call it 10 to 15, that really dominate because they're the only firms with the operational wherewithal to participate at scale. Think middle and back office teams, capital markets desks, servicing infrastructure. And our friends at Valinor made this point pretty clearly on a panel at the Credit Reimagined Summit that I mentioned in March, saying that asset-backed finance is much more, operationally intensive than a traditional loan because it references underlying collateral. And that monitoring is fundamentally a spreadsheet-based process. And so the result is that smaller, leaner managers, even ones with really strong underwriting, historically couldn't compete in short durations receivables at all. And the barrier, again, wasn't credit judgment so much as back office infrastructure. And so I'd say the asset class is also evolving in composition. Asset-backed finance is the fastest growing segment, especially in short duration receivables that are tied to embedded payments or B2B working capital and consumer lending. And these are exactly the assets where traditional infrastructure can break down. And Mike Barbosa at OatFi, one of our partners, described it this way. He originates 5 to 7 day receivables, but his warehouse facility takes 5 to 10 days to fund them. And that, mismatch means that he's bridging the gap, with basically his own equity, which, as he put it, is the most expensive capital on his balance sheet. So the back office tax on this asset class is really so high that even, the lower risk, shortest duration assets are often the least efficiently financed. And so I would say, the 3 structural shifts that are really changing trajectory of this asset class include, first, programmable infrastructure is collapsing the operational stack. We're enabling real-time portfolio verification, automated covenant enforcement, instant settlement. Second, stablecoins are becoming a viable settlement rail, especially post-Genius Act. Regulated stablecoins function economically as tokenized, government money market funds effectively, and they're eliminating the idle balances and pre-funding delays that have really plagued and defined cross-border and B2B settlement. And then third, and I think this piece is particularly underappreciated, is that, programmable rails are creating genuinely new credit, assets. I think, one of our partners said that traditional financing windows started at 15 days because that was the minimum operationally, viable duration. And with faster duration or faster rails, the 0 to 15 day window is now financeable for the first time. And so that's not, again, a better version of an existing product. It's a net new asset class. So when I think about where private credit is heading, it's not just more of the same and bigger. It's a market that's about to look pretty structurally different with broader participation, shorter duration, and a meaningfully, smaller or lower operational tax. And I think that the institutions that recognize that earlier are really going to shape how this next phase gets built.
Brilliant. Okay, so moving on to the next question here. In your view, where are the most critical structural inefficiencies today? I mean, where do you see those inefficiencies?
Great question. There are many that we could talk about, but I'll focus on a few that stand out and how they really map to the programmable infrastructure that we've been building and are showing true impact, in my opinion. So first is fragmented systems of record. If you think about every participant, be it the originator, the servicer, the lender, the paying agent, backup servicer, they're all maintaining their own ledger, right? The cost of reconciling those ledgers through spreadsheets and PDFs and email chains, can extract like 8 to 13% of unpaid principal in consumer lending alone. And most of that's operational, right? It's not credit related, and it doesn't really offer competitive differentiation. One of our partners at OatFi, kind of captured it perfectly. He kind of joked that one of his colleagues is the chief recycling officer because that person spends a few hours a day manually, managing draw and recycle requests across legacy facilities. And so that's, a senior capital markets professional doing reconciliation work that really should be automated. I think the second one that really stands out to me are the timing mismatches between origination and funding. So traditional warehouse facilities run on weekly or monthly borrowing-based cycles with multi-day funding lags. And so for a fintech that's originating short duration receivables, that creates, an equity drag in that the originator's own balance sheet absorbs the cost of infrastructure latency and not credit risk. And I think that there are folks like Fence, for example, that have described comparable structures, cutting total cost of funding by 30 to 40%, and enabling programmatic just-in-time funding. And the savings can come down from infrastructure, not from the cheaper risk pricing. Then the third I'd add is an inefficiency is that of really the borrower is a source of truth risk. In most asset-backed structures today, the borrower produces the loan tape that lenders finance against, and that's a pretty problematic structural fraud vector. And we've seen that play out with the likes of First Brands, for example, where the originator was effectively self-reporting collateral data. And if you think about it, if if none of those participants would have built on chain, or if those participants had built on chain, the double pledging would have been visible. And it's really, obviously on chain visibility is important, but really the data provenance is equally important. The invoice data originates from a third-party accounts payable platform. And you don't have to have a case of the lender trusting the borrower's representation of collateral, and instead referencing data source upstream from a party with like no incentive to manipulate it. And I'd say just as a fourth inefficiency, really higher barriers to entry that limit competition, because like I said earlier, participation really requires massive operational scale. The capital that should be flowing into high quality short duration assets sometimes can't access it. And there are some cases where the smaller entities couldn't participate in this market without new primitives and programmatic just-in-time funding that I mentioned, thanks to blockchain rails. And it's not because they lacked the underwriting capability, is because they lacked the back office headcount to run a traditional warehouse process, for example. And so programmable infrastructure really changes that math entirely. And I view it more as a TAM expansion as opposed to a displacement, and it really will benefit originators through deeper, more competitive capital markets. But the through line of all these is most of these is they're not credit problems. The credit risk is well understood and priced. What's really been mispriced is the operational tax of moving capital through these fragmented manual rails. And once you see it that way, the opportunity of this programmable infrastructure becomes pretty clear, and that the firms that solve the infrastructure issue can capture both better economics and also better risk-adjusted returns.
Very well said. And if I may add to that also the deal size minimums, in fact, because what we have, generally speaking, when we talk about traditional securitization, the ticket sizes are quite, remarkable. However, when we talk about microfinancing those thin file SMEs, the ticket size is going to be quite a different story. They're really not quite comparable. And that also, in my view, is another inefficiency that we are facing today. And I guess it's an area that deserves to be addressed. So the other question is, what is driving liquidity constraints across private credit funds? What are the limitations, the constraints? What do you think?
Yeah, I think there are a few forces that are converging at once. And I think they all have different solutions, right? And we alluded to this earlier, but the first is really duration mismatch. A lot of capital, came into private credit through semi-liquid vehicles, think BDCs or evergreen, structures or interval funds that really promise quarterly or even monthly liquidity against assets that are inherently illiquid and multi-year in duration. And so, as I recall, assets held in evergreen private credit funds reached, I think, about 650 billion as of mid-2025. That was up about 50% year over year. And most of that AUM was held in private wealth-focused vehicles like non-traded BDCs. That worked great in a zero-rate environment when redemptions were minimal and you could say there were more steady inflows, but it works much less well when allocators rebalance or rates reprice or you see shifts in sentiment. And so the liability side became more liquid than the asset side could really support. So that's one constraint. The second I'd allude to is that of operational opacity. Private credit funds typically rely on borrower-produced reporting, be it the Excel files, the monthly tapes, the periodic borrowing-based certificates. And when stress hits, LPs start to ask questions about collateral quality, and sometimes managers don't have real-time answers. I think the First Brand situation exposed this. The fraud and double pledging weren't caught for months because the data flow was just fundamentally manual. And I think with Tricolor's, trustee alleged falsification of loan performance data, the inflated collateral values, double pledging, the fabricated receivables, designed to defeat audits, that opacity really creates a reflexive problem whereby when LPs can't verify what they own quickly, they redeem first and then delve into the questions later. And so I think you could argue that uncertainty itself becomes a liquidity event. And then the third piece I would touch on is really concentration in the funding base. Many private credit managers, as I understand it, rely on a small number of warehouse lenders, insurance company SMAs, or say pension allocations. And so when any one of those pulls back, the manager has more limited optionality, especially for short duration books that turn quickly. And that's more of a working capital crunch caused, again, entirely by infrastructure, not credit necessarily. So the liquidity constraints, again, aren't all about credit performance. They're about really a market that scaled the liability side faster than it modernized its asset side infrastructure. So credit can be fine, and it's really the plumbing that is the problem.
True. Very well said. The next one is more or less about the fund structuring, because that's another important aspect to be considered here. So in your view, I mean, how should the industry rethink that fund structure to maybe better handle those withdrawals? What do you think about that?
Yeah, I think that liquidity resilience is really a design choice. I think the funds built with duration matching, real-time transparency, and diversified funding really hold up. I think the funds, that have built on old plumbing will be tested and continue to be tested. And just to double click on those shifts, I think first off, match the liability terms more to the asset duration. I think the industry needs to stop, pretending that quarterly liquidity is compatible with 3 to 7 year private loans. That doesn't mean, abandoning these semi-liquid structures, but it does mean, pricing liquidity properly, maybe sizing the redemption gates more realistically, et cetera. But I think encouragingly, 80% of private credit assets are already in closed-end structures, with the semi-liquid structures making extensive use of liquidity management tools to prevent asset liability mismatches. And I think, the challenge is that the fastest growing segment, that of the wealth channel evergreen funds, is exactly where, this discipline matters most, and where it's really being tested. Second, I alluded to is real-time transparency being built into the fund itself. I think that's where programmable infrastructure will really change the conversation. If you think about collateral data living on a shared ledger, LPs can verify portfolio composition continuously rather than waiting for monthly NAV statements. And then third, I would say, broaden and modularize, if you will, the funding base. And what I mean by that is, instead of relying on a few large warehouse lenders, programmable facilities can let managers tap multiple liquidity providers against the same on-chain authorization data, with each, deploying their own credit policy. And I think that can apply more broadly, and that a fund can route capital across many providers with different duration tolerances and risk appetites. And that's structurally more resilient than being dependent on a single warehouse line.
Yep, sure. And if I may add to that also, probably building a genuine secondary market, I would say this is another factor that we should be considering. Because if I'm an investor and let's say for any reason, I cannot redeem at the fund level, I mean, at least I should be able to be trading my position at a market discovered fair value in a secondary market. I mean, that would probably solve some of the problems that we are facing recently with those, let's say, rather high rate of redemptions that has happened, and, the recent happenings within the private credit industry. So I would say this is also another design factor that we can also consider when we want to really structure the funds. So the next one is, in your view, now this one is very specific to you, by the way. How does Avalanche's infrastructure enable the RWA tokenization beyond simple digitization?
I would say most of what gets called tokenization today is really just digitization, like wrapping a fund interest or a loan in a token, while servicing, reporting, and settlement still happens off chain and through legacy infrastructure. And so that, in my view, actually adds cost rather than reducing it, because the institutions end up maintaining both the traditional operational stack and then a digital one on top of it. I would say Avalanche is built differently in that the architecture lets the entire asset lifecycle operate on chain, from origination to verification to servicing, settlement, distribution, and not just the securities wrapper, right? And those things matter technically. First of all, Avalanche offers sub-second finality and deterministic performance. And so, Avalanche Consensus delivers near instant finality, with horizontal scalability and also the lowest average fees among leading chains. And for institutional credit markets, that's the difference between a system that can support real-time intraday funding and one that can't. And so really the chain has to keep up with the velocity of the asset, and Avalanche does. Second of all, I'd say EVM compatibility plus configurability through Avalanche Layer 1 blockchains is a differentiator. Builders get the full Ethereum tooling and developer ecosystem, but institutions can also launch purpose-built chains with their own validator sets, KYC enforcement at the protocol layer, custom gas tokens, custom compliance logic that's embedded into the chain itself as opposed to bolted on through middleware. I think Intane is a great example of this. They run an Avalanche Layer 1 blockchain. They have an asset-backed finance platform. They're powering a $430 million pilot with FIS that connects 2,000 banks for structured finance administration. That can't sit on a public chain, really requires a controlled environment with bank-grade governance. And so Avalanche, Layer 1 architecture really lends itself well to that without sacrificing security or interoperability. And then third thing I'd call out about Avalanche is really the composability across permissioned and permissionless environments. We have a swath of tokenized assets available from BlackRock's Biddle to Franklin Templeton's Benji, Apollo's ACRED, Janus Henderson's JAAA, KKR's Healthcare Growth Fund, VanEck's VBill, the list goes on. Those can live in controlled environments and still flow into productive utility through the public permissionless environment we have called our C chain. And so that's only possible because Avalanche's multi-chain architecture lets institutional grade environments interoperate if they wish with permissionless DeFi when it serves the use case. So all that's to say the technical case is pretty straightforward in that it's, tokenization isn't valuable because it puts the assets on a blockchain. It's really meaningful in that it puts the ledger on a blockchain, and Avalanche is built to be that ledger with the performance, the configurability, and composability that institutional credit markets really require. And then I'd also add, like, most tokenization conversations get really stuck on the tech, and the BD lens from my side is different. The question is more about like what can the partnership and how fast using the integrations on Avalanche. And so we work with everyone from fintechs to neobanks to asset managers to payment companies that don't want to become blockchain companies necessarily. They just want to offer better products faster. And they want that infrastructure to be invisible. And so we have already all of the integrations from a wallet perspective, from a yield as a service perspective, from tokenized US equities infrastructure perspective, and that allow for better UX, new revenue, deeper customer relations, and with Avalanche as a settlement layer underneath that. And really, that's because it's a high performing chain. That's being a high performing chain is table stakes. And so what in my view sets the stack apart is really the curated bench of design partners around it that allow institutions and other companies to launch quickly.
All right. Now this question could be a little bit more technical. So the question is, what role do subnets, considering that the Avalanche's layer ones, play in scaling institutional grade credit markets? Some audience probably may not know the subnet, so that's why I call this a bit of a technical question.
Yeah. So first of all, Avalanche L1s are what we used to call subnets. They're custom blockchains that institutions can launch with their own validator set, their own rules, their own economics, but also while still inheriting the security and interoperability of the broader Avalanche network. And so for institutional credit markets specifically, that solves three problems at once. First, regulatory flexibility. Institutions can require KYC at the validator level. They can restrict participation to whitelisted counterparties. They can enforce compliance logic directly in the protocol and not, as I mentioned earlier, bolted on through middleware. Second is performance isolation. If you're a high velocity credit business that gets deterministic throughput, predictable gas, and guaranteed uptime, that's a better alternative than competing with unrelated activity on a shared chain. Third is composability without compromise. So an institutional layer one blockchain can still tap into the stablecoin liquidity, into the tokenized assets, into the DeFi utility on the Avalanche public permissionless chain. It's called the C chain through interchain messaging when it makes sense. And that offers native interoperability, so there's no bridging mechanisms required, and it's all within the Avalanche ecosystem. And I mentioned this earlier, but Intane is a really good proof point. They run the asset-backed finance platform on their own Avalanche Layer 1 blockchain. They recently partnered with FIS, core banking technology provider, to launch the digital liquidity gateway. And that's a marketplace that connects roughly 2,000 regional and community banks to institutional investors so that they can securitize and then also trade loan portfolios on chain. That kind of bank grade infrastructure can't really sit well on a public chain. It really needs purpose-built rails with controlled governance and with direct integration into existing core banking systems. So again, this goes back to our earlier point and thesis that institutional finance won't and can't move to a single chain. It'll really move into a constellation of purpose-built environments that share security and interoperability primitives. And I think Avalanche's Layer 1 architecture is the only design delivering that at production scale today.
All right. Now, this question over here, probably you've addressed part of that, but let's have it in one piece again. So how can tokenization improve transparency, settlement, and capital efficiency in private credit?
Definitely. And I mean, those are all pretty connected. I think they all tackle, though, a different inefficiency in private credit. So I'll take them in turn, and hopefully I'll remember the sequence properly. But I think you said transparency first.
Transparency.
I think that's the dominant fraud vector in private credit today, being that of the borrower's source of truth. And I mentioned this earlier, most asset-backed structures, the borrower produces the loan tape that lenders finance against. And with First Brands, for example, filing for bankruptcy in September, I think it was, with allegations of double pledging, Tricolor executives were charged with systematic fraud later, and they, allegedly pledged the same auto loans to multiple lenders simultaneously and manipulated the loan data so that the delinquent loans appeared eligible for financing. Neither of those companies were on chain, but if they had been, double pledging would have been pretty apparent. And so I think the deeper innovation in well-designed tokenization isn't just transparency. Again, it's also data provenance. So when an invoice or collateral data originates from a third-party workflow platform and it's recorded on chain, the lenders aren't trusting the borrower's representation of the asset. They're referencing the data sourced upstream from a party with really no incentive to manipulate it. And that changes the structure of trust in a facility. I think the second piece you mentioned was settlement. Traditional
Yes,
private
correct.
credit facilities really require coordination among collateral agents, the backup servicers, the paying agents, the warehouse banks before capital can recycle. And so even a 12 to 24 hour delay is pretty costly when you're financing receivables that turn over in days. And programmable settlement collapses that. There's a public dashboard for this particular pilot done on Avalanche, but there's an OatFi and Valinor facility that was administered through Fence on Avalanche's public permissionless C chain that replaced multi-day funding cycles with programmatic just-in-time funding. So the capital deployed in real time against asset origination rather than after a manual borrowing base submission. And I mentioned this statistic earlier, but I'll repeat it, again, that Juan at Fence has described comparable structures cutting total cost of funding by 30 to 40%. And importantly, it wasn't from lowering the interest rate. It was purely infrastructure savings. And so I do believe that settlement velocity is really a hidden form of cost of capital, and tokenization addresses that directly. I think the last one you said was capital efficiency. Is that right?
Exactly.
Yeah.
That's correct.
I think
Yes.
that's where the three pillars really compound. Like when you have transparent collateral data, programmatic settlement, and a shared system of record, you can eliminate the operational overhead that has extracted 8 to 13% of unpaid principal in consumer lending, for example. You eliminate the equity drag I mentioned earlier that originators carry when they have to bridge funding gaps with their own balance sheet. And you also broaden the funding base because instead of relying on a few large warehouse lenders, programmable facilities can let multiple liquidity providers, deploy their own credit policies against the same on-chain transaction data. And we're seeing this play out across the Avalanche ecosystem with players like Valinor, with players like Fence, the credit coops of the world and others.
Okay, sure. Now, this question over here is more about the aspect of the private credit, whether it can be programmable or not. So what does it mean exactly to make private credit programmable in practice? I mean, if you can give some examples or use cases of that. I'm sure you did already, but just to recap.
Yeah, no, I think programmable gets thrown around a lot. So I can be more concrete about what that means in practice. If you think about a private credit facility today, it's governed by hundreds page long legal agreement. And that's a credit agreement that defines the borrowing base, the eligibility criteria, the covenants, the cash waterfalls, the reporting obligations, and more. And all of that is enforced manually. It's pretty incredible to think that people pull data into spreadsheets, calculate the borrowing base, email PDFs to a paying agent, wait for the approvals, and then wire the money. And that process can take days, if not weeks, for a single drawdown. And so making private credit programmable means encoding those rules into smart contracts so that the operational mechanics execute automatically while the legal agreement remains as the underlying source of truth. And so, again, in practice, what that looks like is first automated funding. When a new asset meets the eligibility criteria that are defined in a facility, the capital can be deployed in real time as opposed to after a manual borrowing base submission. Second is real-time covenant monitoring. So instead of receiving a quarterly compliance certificate from the borrower, lenders can see the covenant status, update more continuously as the portfolio changes. If you think about a covenant being breached, the system flags it the moment it appears, not 3 months later in a reporting package. Third, you have automated cash waterfalls. So you have repayments flowing through predefined logic with senior lenders getting paid first, then mezz, then equity, all executed by code rather than by a paying agent that's reconciling numerous spreadsheets. And then fourth, I'd say, is the shared state across counterparties. So every participant, be it the originator, lender, servicer, agent, references the same on-chain ledger. There's no more bilateral data files or reconciliation between 5 different versions of the loan tape. So I would say what programmability does not mean is removing human judgment from credit. So underwriting, restructurings, covenant waivers, founder evaluation, probably others, those remain human. What gets programmed is the operational layer that has, historically required armies of middle and back office staff to manage. And really, the programmable infrastructure doesn't change the credit decisions, but who can participate in the market and how efficiently capital recycles once those decisions are made. So to put it simply, I'd say the legal agreement is still the source of truth, but the smart contract is just a smarter, better, more transparent way to execute it.
Okay. So yeah, following up on what you just explained over here, the next question also connects to that somehow because it's about how on-chain logic reshape the repayment cycles or cash flows or the investor access to the fund. So I would say somehow it's in connection with what you were just explaining, because once the asset is on-chain, it's fully transparent, and a lot of those unnecessary steps or time-consuming steps basically will be removed, and the process will be streamlined. And especially when we talk about the cycles, the cash flows and the repayment cycles, and splitting of the repayments for different parties who will get their share of repayment. This can be happening within a few seconds or a few minutes instead of waiting for a long time to be settled.
Yeah, absolutely. And I think that the through line of all this is that the on-chain logic doesn't change what private credit is. It's really the cadence at which capital moves. It's the determinism with which it flows, and really the pool of entities who can participate. And so each layer, enables, another. Like the continuous repayment makes programmable cash flows possible, and programmable cash flows make more modular investor access possible. And that's an expansion of the market. It's not just a more efficient version of it.
Fatra focuses pretty much on short duration SME financing and lending. So how do you view this segment within the tokenized credit? I'm sure you explained about that.
Yeah, absolutely. And I think short duration SME lending is, one of the more important segments in tokenized credit. And I know Fatra is targeting it in a region where the structural credit gap is pretty acute. I think why this segment matters, SME credit globally has been pretty underserved by traditional banks with rigid underwriting, balance sheet constraints, and maybe you know better than I would, but risk averse models that exclude otherwise viable businesses from working capital access. I think that's been true in the US. It's been pronounced in LATAM and APAC, structural in the GCC. And so I think you all are, addressing exactly that gap of originating SME loans across the Gulf, structuring them in Sharia compliant form, and then tokenizing the credit exposure so, investors can access a segment of an economy that's really been hard to reach at scale. I think what makes short duration SME lending well suited to tokenization is that, again, the operational tax on this asset class is pretty high relative to the ticket size. So a traditional private credit fund can economically service a portfolio of small duration, small short duration SME loans because the back office costs of monitoring and reporting and reconciling each position, can really eat the spread. I think tokenization helps change that math so that when a loan ledger lives on chain, the monitoring is automated, the performance data is verifiable in real time, and then the operational overhead that has traditionally gated institutional participation starts to collapse more. We've seen that play out in B2B receivables with our partners OatFi and Valinor, where short duration, high velocity, traditionally underserved, asset class by legacy infrastructure has become financeable when the rails, that is blockchain rails, support it. I think the other reason this segment matters is because of investor access. Again, tokenized SME credit makes a path for global institutional capital, be it pension allocators or family offices, to gain more diversified exposure to an asset class without needing to build local origination infrastructure. I think you guys are working on a 3-tranche fund structure well designed for that. And that's how you bring TradFi allocators into the asset class, is by really giving them risk segmentation that maps to the existing legacy portfolio construction frameworks. Where I'd push the conversation with a platform like Fatra is really on the questions that determine, whether tokenized SME credit lives up to its promise. Like, how is collateral data sourced? Is it from the borrower, from upstream workflow systems? How is fraud or double pledging, risk mitigated? What does the secondary market look like we said earlier? And how do you, go about handling liquidity at the fund level? Those are the same questions that determine cost of capital in any tokenized credit structure. And they're especially important in regions where investor protections or regulatory frameworks may still be maturing. So I'd say on the whole, short duration SME lending is a higher, high conviction segment in tokenized credit because the operational unlock is pretty pronounced, where, ticket sizes are small and durations are short. I think the execution challenge is the standard one. You have to think about origination quality and fraud controls and regulatory alignment. But the logic is solid.
Super. Now, on the topic of scalability, do you see SME credit as a more scalable and liquid-friendly asset class?
Yeah, I think that's a great question. I think it's a bit complicated. I think the answer depends on which dimension of scalable and liquid friendly you're asking about. I think on scalability, SME credit is compelling, right? The TAM is enormous, structurally underserved. SMEs represent the majority of employment and economic activity in most economies, and they've been underbanked, underserved because traditional credit infrastructure can't economically service small short duration loans. I think tokenization will help improve and alter that. When monitoring, reporting, and servicing become automated, the operational cost per loan drops, which means you can finance ticket sizes and durations that legacy private credit couldn't touch. I think that's an indicator of an expansion of the market. And again, not just a more efficient version of the one that exists today. On liquidity, I might push back a bit on that framing. I think SME credit is fundamentally in a liquid asset class. I think these are, if you think about private loans to operating businesses, often with limited secondary markets, I don't think tokenization really changes the underlying credit reality, right? What tokenization can change is the operational liquidity. So how fast capital can recycle within a facility, how fast an investor can subscribe or redeem at the fund level, and how transparent performance is and can be tracked in real time. I think that's a big improvement, but it's different from saying SME credit becomes a liquid asset. And I think investors who treat it that way can get burned. And I think that's why the industry has been reflecting in the last few years and recalibrating expectations around these evergreen and semi-liquid private credit structures. So I'd say the more nuanced take is that tokenization makes SME credit more accessible and more operationally efficient, which can expand who can participate in it and at what scale. But the underlying duration and credit characteristics don't change. A 90-day SME loan is still a 90-day loan, whether it's on chain or not.
Very well said. And if I may add to the second point, which is about the liquidity friendliness, I mean, the fact that we can shorten the duration of loans, I mean, it would be considered a plus. However, still there are some, let's say, potential caveats that we have to consider. One of them is that no matter what, we should always have a rigorous process of underwriting, and we have to be, let's say, scrutinizing the process to make sure that the underwriting is done in a disciplined way. And on top of that, I would say also the diversification across different borrowers, different sectors. This is also another factor that needs to be considered. Otherwise, we will end up just having a concentrated portfolio of loans.
Right.
So I would say those are also among factors that needs to be taken into account.
Yeah, and I would add to that. I think it's really interesting, or I think SME credit becomes particularly interesting at the shorter end of the curve. Think like invoice receivables, working capital lines, embedded credit that's tied to payment flows, because that's really where the operational unlock is pretty pronounced, where duration is naturally short enough to support a more dynamic capital model, and where the real-time data infrastructure of tokenized rails maps to the underlying business activity. And I think, OatFi and our ecosystem is a clean example of that thesis in B2B payments. I think at Fatra, you're targeting an analogous opportunity in the GCC real economy SME lending. So I think it does, again, like not all SME credit is created equal. And I do think there are compelling opportunities at the shorter end of the curve.
Okay, so now in the interest of time, I may probably fast track over some more questions towards the end. Now, we talked about the secondary market earlier. Now, if you could briefly mention what conditions are required to enable the true secondary liquidity in the tokenized credit markets.
Yeah. I would say, and I'd love to hear your thoughts on this as well, is that there are a few conditions, and I think the industry has probably two of them today, but I can just delve into it. I think first, standardized data and reporting. A buyer in the secondary market needs to assess collateral, covenant status, or performance quickly. That means real-time data sourced from upstream workflow systems and not borrower-produced PDFs. Tokenization enables that, but when the underlying asset ledger is on chain as opposed to just a wrapper. Second, I think a deep buyer base with diverse risk appetites helps. I think liquidity requires segmentation. Investors just have different duration tolerances and yield targets and risk profiles, trading against the same shared data. And I think that's the open credit vision that we have, and we're early there. I think third is regulatory and legal clarity around transferability. In the US, UCC Article 12 is a step in the right direction for digital asset security interests, but it's only adopted in roughly half of US states, and the case law is pretty minimal. And I think cross-border transferability is even messier. And so without that legal foundation, institutions can't really transact at scale yet. And then finally, a fourth one I'd flag is that of term structure. So most, current tokenized credit blurs the line between yield and immediate liquidity. I think real secondary markets need clear pricing of duration risk so that a 90-day loan trades differently from a 5-year loan. So all that's to say, liquidity isn't a tech issue, right? It's a market structure problem. I think tokenization is helpful but not sufficient, and I think we get there when we have the data mixed with the buyers, mixed with the legal frameworks and term structure maturing together.
Okay. And just a closing question over here. How do you see platforms like Avalanche shaping the future of private credit?
Yeah, that's a great question. Well, I would certainly say, Avalanche's role in private credit is, obviously being a faster blockchain, but it's also more importantly being the settlement layer where institutional finance actually rebuilds its operational stack. And I think we're already seeing the contours, if you will, of how that plays out. First of all, I think Avalanche becomes the substrate for institutional credit infrastructure. Again, as the underlying ledger. That's what Intane and FIS are demonstrating with the digital liquidity gateway. They're connecting 2,000 regional and community banks to institutional capital through a purpose-built layer 1 blockchain. It's what our partners like OatFi and Valinor and Fence are demonstrating with programmatic just-in-time funding on the Avalanche C chain. It's what BlackRock's, Franklin Templeton, Apollo, Janus Henderson, Van Eck, Wellingtons of the world are demonstrating by issuing tokenized funds on Avalanche. And really the thread connecting all those is that Avalanche is the chain institutions are choosing when they want production bank grade infrastructure with regulatory flexibility. Second of all, I would add that Avalanche, enables a constellation of purpose-built environments rather than one monolithic chain. That matters because institutional finance won't consolidate onto a single blockchain. It'll fragment into different environments that need to interoperate with stablecoin liquidity, tokenized assets, and DeFi utility. And Avalanche's layer 1 architecture with native interoperability is really, again, as I mentioned earlier, the only design enabling that at production scale today. And then finally, I'd say, Avalanche really compresses the operational stack that's gated institutional participation in the past. There are many entities that couldn't participate in short duration receivables markets without certain primitives. And it's not because they lacked credit judgment, but really because they lacked the back office headcount. And so Avalanche bank, based infrastructure changes that math, which means more managers compete on credit selection rather than operational scale, and which, in my view, in turn, broadens capital access for originators and improves, the risk-adjusted returns for allocators. So the longer arc is this, private credit grows past the $3.5 trillion globally because the asset class works, but the operational tax on participation has really concentrated the market in a handful of larger managers and excluded shorter duration, credit from institutional access. And I think Avalanche's role is to remove that operational tax, make the market broader, faster, and more transparent without changing what credit fundamentally is. And the institutions that build on Avalanche now are really positioning to capture both the economics and the standard setting role for the next phase of private credit.
Well, Olivia, thank you so much. It has really been a very substantive conversation, and I really appreciate you for giving us this much of your time. And to all the audience, also, we appreciate your time and joining us in this session. So please stay tuned until our next episode. Have a good evening. Thank you.
Great. Thank you so much for having me.